Hello, it's Jeffrey Christian of CPM Group. It's 11:20 a.m. in the morning of Tuesday, the 18th of February here in New York. I want to talk about the relationship between gold prices and recessions today. I'll talk a little bit about our shorter term views for gold, silver, platinum, palladium uh, at the end of this video. But right now, I want to focus on gold prices and recessions. And I want to do that for a couple of reasons. A, gold prices are rising. B, the potential for a recession in the next 12 to 24 months the probability has increased over the last 9 months. We had been expecting a recession possibly as early as 2024, 2025. 2024 was a pretty strong year, but some of the pressures that are indicative of potential recession sooner rather than later have grown more prominent over the last 9 months of 2024, suggesting that there's a higher probability of a recession this year, next year, than there was last year. Investors have been asking, what's the relationship between gold prices? Don't gold prices generally rise in a recession? And generally, they don't. The relationship is much more complex than that. You would think that when we're in a recession, investors would buy more gold, and that would drive the gold price higher. And to some extent, that's true. But what's really true is that as we lead into a recession and a recession becomes more obviously imminent, investors will buy more gold. And that's because in the late stages of an economic expansion, consumer investor wealth is at its greatest in terms of increases. So people are feeling wealthy. The stock market hasn't started to fall sharply. The bond prices haven't started to fall sharply. The yields haven't risen sharply. Investors are feeling wealthy, but they're also much more concerned about the state of the economy and the potential for declines in stocks and bonds. So they tend to buy more gold in the late stages of the economic expansion before the recession actually begins. Offsetting that is that you do see with a recession that investors have less discretionary money and disposable income, so that they're buying less jewelry and discretionary items that like jewelry and decorative items that have gold. And investors will have less money to invest in gold once their other assets have started to depreciate in value as the recession starts. Now, if you look at long-term gold prices since they were freed to float in 1968, we saw gold prices rise in 1968 from $35 up to about $68. Then they came back off. They started rising again around 1971, 72. They peaked on December 31st, 1974, the very time Americans were allowed to own gold starting at midnight on December 31st, 1974. And the gold price peaked that day in anticipation that investors would be buying a lot of gold once they were allowed to. And in fact, they pulled back from buying so much gold, and the gold price fell from December 31st, 1974 into around 1977. Prices rose from 77 to 1980. Then they came back off. They fell to a cyclical low in 1982, the middle of 1982. They rose again into around $500 by the end of 1982, but then fell into 1985, rose from 85 through 87. We had a non-recession. We had a stock market collapse drop in September and October of 1987. A lot of people thought that would precipitate a recession. It didn't precipitate a recession, but the gold price was rising partly again as asset prices fell, and we didn't see a recession, and the gold price slipped back. There's a little bit of an increase in 1993. Then the gold price fell and traded between, say, 250 and 300, 300 for about 5 years, from 1997 to 2002. Started to rise again in 2002, peaked in 2011, came back off until 2016, moved sideways for a few years, started to rise in the second half of 2019, and they've been continuing to rise. Now, that's the ebb and flow of gold prices, and we'll talk a little bit about recessions. This is real world GDP, world real GDP in the actual levels. And you can see periodic recessions. If you look at it on a percent change year over year, then you can sort of see the recessions in 1973, 75, 1980, 82, small one in 91, didn't really decline into a recession in 2001 on a global basis, although it did in the United States. I'll show you that in a second, because we're going to talk about US recessions. And then again, 2007, 2009, 2020. So those are global, and these are US recessions. Very similar, but you will see, for example, we did have several quarters of negative growth in 2001. That was the internet stock bust. There were a number of financial scandals in the equity market and on a corporate level. And we did see a short, shallow recession at that time. The big one in 2007, 2009, and the really steep one for 2 months in 2020, engineered by the governments of the world. These were the actual dates, 1969, 1970, and there was an 11-month-long recession. Gold prices basically rose prior to that recession and didn't really rise during the recession. If anything, they maybe came off from about $68 down to about $40, $37, something like that. Gold prices started rising in 71, 72. They rose into the recession from 73 to 75. There was a 16-month recession. They rose into, through December of 1974, but in the final 3 months or final quarter of a recession, the gold price had already started to fall. But gold prices were rising, and they were responding to a variety of factors, including global political issues and rising inflation. The government had the Council of Wage and Price Controls, and tried to control inflation by setting prices and price increases that were allowable, both on salaries and on goods and services. Didn't work. It's kind of a learning experience for the U.S. government. We saw modest recovery and into January of 1980. And then we had a 6-month recession. We had this double dip recession. We had 6-month recession in 1980. We came out of that for 12 months, went back into another recession that lasted 16 months into November of 1982. And these are measured peak to trough. So it could stay in pretty bad shape economically after the trough was reached in the early stages of resumed growth, prior to what we would consider a recovery or an expansion. Economic recovery after a recession is defined as a period of economic growth that gets you back to the peak level of GDP before the recession started. And then after you cross that, if the economy continues to grow, you have an expansion until you have a mature expansion and you slide back into a recession. So we did see that recession, double dip recession, 6 months, 12 months of recovery, and then another 16 months of recessionary conditions into November of 1982. During that period of time, gold prices basically fell. They declined from 850 on an intraday basis in January of 1980, the beginning of the first part of that double dip recession, gold prices peaked. Gold prices rose into that recession and fell during the recession, and for all the reasons I told you earlier. They hit that low in June or July of 1982. And at that point, the central banks of the world got together with the Plaza Accord, and the Plaza Accord came later, I apologize. They got together and they opened the sluices monetarily, flooded the world with liquidity, got us out of that recession over a 6-month period of time. Gold prices rose during that period from July of 1982 into December of 1982, January of 1983, but then they peaked and they came back off. And they fell back to levels below $300 in 1985. Started to rise in the first quarter of 1985 and continued to rise. We did not have a recession in 1987, but the gold price continued to rise because the stock market and the bond market were having problems. And from a competing asset and portfolio diversification, gold made a lot of sense. So you saw gold prices rise when there wasn't a recession. That recession didn't occur until July of 1990. It lasted until March of 91, so about 8 months, relatively short and shallow by recession standards. The average recession in the last 80 years has been about 10 months, I think. And the average recession from like the 1860s into the Civil War up until 1920 was about 21 months. So you've seen shorter, shallower recessions since World War II. And then you had a couple really short and shallow ones with a decade between them. From 1982 to 1990, you had economic growth, as opposed to 4 to 6 years between recessions prior to 1975, 1980. You started seeing 10 years between recessions and then a short, shallow recession, 10 years between recession, short, shallow recession, 10 years, and then a deep recession, 2007 into 2009, followed by an international sovereign debt crisis, including the United States, which saw the Treasury credit rating downgraded in August of 2011, and the gold price peaked in 2011. Now, that's an interesting time because that was a very severe recession. It lasted 18 months. It was combined with a global financial crisis. You saw massive problems with liquidity, which caused a lot of transactions to shift from over-the-counter principal-to-principal transactions into exchange-traded transactions. You saw that in equities and bonds and currencies. You also saw it in gold and silver. So you saw a big shift away from OTC trading, forward trading in gold and silver, into exchange traded trading. And that was because the liquidity was still there on exchanges thanks to the clearinghouse system. You weren't trading principal to principal with others. On the principal to principal over the counter market, you had increased counterparty risk because you were trading with one particular company, a bank or a brokerage house or a trading company. And the liquidity dried up in that and the credit risk rose, so that a lot of the trading shifted to exchanges at that time across financial assets. People saw a big surge in gold and silver trading on the COMEX, and they read all kinds of inaccurate conclusions as to why that was happening. What was really happening was that the OTC liquidity and credit risks rose, liquidity declined, dried up in some instances, and so you had trading shift to clearinghouse-based exchanges. Very important to understand. We had a 2-month peak to trough recession in February 2020 into April of 2020. Gold prices had already started rising. Going back to the big recession, the Great Recession and the global financial crisis, gold prices started rising in 2002. The dollar peaked in early 2002 and started to decline for a few years. And gold prices started rising about the same time that the dollar peaked. So again, gold was reacting to something other than recessionary economic conditions back then. But gold prices started rising in 2002. They rose for 5 years before that recession, and then they rose through that recession all 18 months. Well, they rose over $1,000, they came back off, and then they rose again, and then they continued to rise for 2 years, well, 2 years and a quarter after the recession had ended because of the international debt crisis that was going on in Europe and the United States and in other countries and parts of the world. So that's important. Gold prices traded sideways 2016, 2019. In the second half of 2019, they started rising already. There were a variety of issues behind that. In February 2000, well, March 16th of 2020, really, you had a global lockdown, and that threw us into that very sharp recession for 2 months of declines, and then we started recovering after that. So that's the relationship between gold prices and recessionary conditions. There's no pat relationship. Gold prices sometimes rise before the recession starts. Sometimes they rise through the recession. Sometimes they fall during a recession. The movement toward a recession tends to be bullish for gold. Once you get into a recession, it depends on what else is going on, whether or not gold prices continue to rise. And that's why accurate analyses of what's going on is very important. I did say that I wanted to talk a little bit about where we are on a short-term basis. As I was starting to make this video 15 minutes ago, 16 minutes ago, the gold price was $2,930. CPM Group has a buy recommendation for its trading recommendations now. We had a buy recommendation earlier, and then when the price touched $2,933, around the 11th of February, a week ago, we issued a short-term sell recommendation with a 288 or $2,880 target. The price got down to about $2,888 the last couple days, and it's been picked up. It's like, as I said, $2,930, which is where we had issued that sell recommendation. We are in the process, as I speak, of coming out with a buy recommendation with a potential target of $2,990, and the possibility of a spike to actually touch $3,000 over the next couple weeks. And that's for a variety of reasons. There are a lot of political and economic issues that are going on. There could be some political surprises, both on a global basis and within the United States. Things are very tense around the world. In addition to that, you have a move toward the March delivery period for COMEX silver. Silver is trading around $32.96 as I was speaking. It had gotten up over $33 again earlier this morning. It's pulled back a little bit. Our short-term recommendation has been that the silver price could spike easily back up to $35, which is where it was at the end of October, briefly. And we're looking at the delivery period of the COMEX active March silver contract, which is, as of yesterday, you still had 421 million ounces of March open interest to roll into May and forward months. That transition, buying back your March shorts and selling May and July, is going to continue, and that could push the silver price back to $35 or even higher over the next couple of weeks. Once the roll is over, we think that the silver price and the gold price might come back off. We have had sell recommendations for platinum and palladium, and the prices are moving toward those targets. And if you are a retail investor product client, then you would get our silver, platinum, and palladium, as well as enhanced gold trade recommendations through that program. So that's our view on a shorter term basis. I guess next week we will be doing our Silver Facts and Fantasies online seminar. It's free and open to the public, but you need to register. You can go to our website to this link here and you can register. It's next Wednesday, 10 a.m. Eastern Time. Tends to go for an hour or two, and people can either send in questions ahead of time or they can write in questions during the webinar. People who are participants who have registered will get a complimentary small report, CPM Group's report called Silver Truths, which is a summary of what we see going on in the silver market at that time. It's sort of a prelude to our March or our May release of our Silver Yearbook, which is more than 200 pages and much more detailed data and analysis as to what's been happening and what is happening and what we expect to happen in the next year or so in the silver market. We are working on our gold yearbook now. We'll release that March 25th. Silver report comes out in late May. Platinum yearbook comes out in July. You may go to our website, pre-order the yearbooks, order last year's yearbooks, buy other types of research and consulting services, sign up for the retail investment products program to get those short-term trade recommendations. You can send us in queries at info@cpmgroup.com and ask us how we might be of service. Most of our clients take a package of research and consulting services. Some of them use us for asset management, advisory, and management services, or commodities management services. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world. We'll speak to you at the end of the week.